We just crossed the line that has never been crossed before in financial history, and it's absolutely terrifying. The margin debt in the US stock market just exploded past $1 trillion. And if you think that sounds scary, wait until you hear what happened the last time we saw leverage levels like this. And spoiler, it didn't end well. Stay with me because what I'm about to show you could save your portfolio from complete destruction. Welcome back to the channel. I'm your host, Ali, and if you're new here, I bring you urgent market analysis that you need to hear. And I apologize for the regular audience because I've been putting out scary stories, but that is the reality we're living in today. And we're going to be diving into the most dangerous trend in the markets right now, the explosion of margin debt. This has reached actual terrifying levels. This isn't just another metric on a chart somewhere that you can see go up and down and be like, okay, I know about this. This is a flashing red warning signal that has preceded every major market crash in history. And by the end of this video, you'll understand exactly why smart money like Warren Buffett is literally hoarding the most cash he's ever done while retail investors are betting their lives on borrowed money. All right, we're going to explain this in 4 simple key points. Let's start with the numbers that should make every investor's blood run cold. According to FINRA data, margin debt just reached $1.06 trillion. That's trillion with a T. This represents a 26% increase from last year and an absolutely insane 18% surge in just the past 2 months. To put this in perspective, this is the 5th largest 2-month increase on record. But here's where it gets really, truly scary. When we look at margin debt as a percentage of GDP, we're now at 3.5% of total economic output. During the dot-com bubble in the 2000s, it was only 2.6. Before the 2008 financial crisis, it peaked at 2.5. We are now in completely uncharted territory. Now, let's think about this. If we adjusted for inflation, the $278 billion in margin debt before 2000 crash would only have been worth $154 billion today. The $400 billion before in 2008 would be at $263 billion today. We're now sitting at over $1 trillion. This isn't just a bubble. This is the mother of all leverage bubbles. All right, let's look at point number 2, which is the historical parallels. Now, here's where the story gets absolutely chilling. Every single major crash that happened in history has been preceded by this exact pattern. Explosive growth in margin debt followed by catastrophic collapse. In 1929, nearly 40 cents of every dollar loaned in America was used to buy stocks. When the crash came, the math was brutal. As the stock's prices fell, brokers issued margin calls, demanding more cash. Investors couldn't pay, so they were forced to sell at any price. This created the death spiral. More selling led to lower prices, which triggered more margin calls, which forced more selling. For people who weren't doing margins, their protection sell orders were also triggered due to the same thing, which fed that death spiral. The same pattern repeated in 2000 and 2008. Everything has happened in the same way. Here's the terrifying truth. We're not just repeating history. We're actually far exceeding every previous warning level. The current 26 year-over-year growth in margin debt is among the fastest on record. This isn't a yellow flag anymore. This is red alert. All right, everyone, we're going to get to point number 3, which is the margin call death spiral. Let me explain exactly how this house of cards will collapse and why it will be worse than anything we've seen before. Because for those who don't know, when you buy a stock on margin, you open up a margin account with a broker, and you're required to maintain an equity level of around 30%. If your portfolio falls below this threshold, you get a call from someone very angrily saying, hey, you better pay up or we're going to sell your stocks. Here's the nightmare scenario. With $1 trillion in margin debt, over a 10 to 15% decline will trigger a massive margin call. Now, millions of leverage investors will be forced to sell at the same time. And here's where it gets even worse. There won't be enough buyers. Remember the Archegos collapse in 2021? If you haven't heard of it, that was just one family office with 20 billion in leveraged positions. When their margin calls hit, it wiped out the entire position in 48 hours. and it cost major banks billions. Now imagine that scenario multiplied by 50, because that's essentially what we're looking at with $1 trillion in margin debt. The modern market structure makes this even more dangerous. High-frequency trading and algorithmic systems will accelerate the selling. What took 2 weeks to unfold in 1929 could happen in hours today, because we have automated systems that will trigger and sell and trigger and sell. And if you're sleeping, if you don't have stop-sell orders, if you're not watching out for these signs, even your stop-sell orders won't save you, because there won't be enough buyers. And I apologize again, I'm not trying to scare you to death or force you to dig a hole and hide your head in the sand, but this is the reality we are living. And the more information you know, the better prepared you can be. Okay, final point, warning signs and smart money. How do we know this bubble is ready to burst? The warning signs are actually everywhere. We've mentioned a lot of them in previous videos. Warren Buffett, some would say the greatest investor of all time, has accumulated a cash position of 30%, which is $344 billion. That's a record high for Berkshire Hathaway. He's not just sitting on cash, he's also selling some of his major positions. The Shiller-Cape ratio is its third highest level ever. We're in what the economist David Rosenberg calls a gigantic price bubble. Mark Spitzangel is predicting the biggest market crash since 1929. These aren't random doom and gloom predictions. These are warning signs based on mathematical certainties. The leverage cycle always ends the same way, with massive deleveraging that destroys wealth on an unimaginable scale. The question isn't if this bubble will burst, it's when. And with margin debt growing at the fastest pace since 2007, that when might be sooner than you expect. I'm not telling you to go out and sell all your positions tomorrow or anything like that. But what I will tell you is you need to build a cash position and only keep strong stocks. Look at Warren Buffett. The only stocks he's holding on to are ones that can survive this type of crash. And make sure that you have commodities like gold, physical gold to be exact. Gold miner stocks are good for returns, but they don't do as well as gold during tumbles like 2008. Now, if this analysis has opened your eyes to the danger lurking in the shadows, make sure you subscribe to the channel. We would love your support. Like this video, and most importantly, share this with people you love that are in the markets. Make sure they are just as prepared as you are. Guys, the $1 trillion margin debt bomb is ticking. And like we talked about in previous videos, there's a lot of people out there that are passively investing and blindly putting their money into the indexes. History doesn't repeat, but it sure does rhyme. And right now, it's rhyming with 1929, the 2000, and the 2008 all at the same time. Don't let the euphoria fool you into thinking that this time is different. This time is not different. And at StockScope Live, we bring you hard truths, and financial media won't tell you these things. Because just as much as it's scary for you, it's also scary for us. Stay vigilant, stay prepared, and whatever you do, don't get caught in the margin debt death spiral. If you have positions on margin, get out. I'll see you in the next video. Until then, stay safe.